today, which directly tackles an issue that is central to the future of infrastructure. And that is the funding and financing of infrastructure in a context where, due to COVID-19, governments have very limited fiscal space capacity to fund the infrastructure needed for a more resilient and sustainable future. So average public debts across G20 economies at the end of 2020 were between 50% and 100% higher than they were following the global financial crisis. And these debt levels are limiting government's ability to execute stimulus through public investment. And at the same time, we are faced with a situation where the private sector has stated its willingness to invest in infrastructure, but private investment has not been at the levels hoped to help to close the infrastructure funding gap. So that's against this backdrop that in January 2020, the GIHub started its initial work on an innovative funding and financing tool, responding to a G20 request to provide practical solutions and levers for attracting and increasing private investment in infrastructure. So the tool was released at the end of 2020 and includes actually a framework that showed the different options you have to fund and finance infrastructure, supported by 60 case studies that very often include also the support of multilateral and regional development banks. After it was presented to the G20 Infrastructure Working Group in January this year, the group asked the GIHub to continue progressing the work, ensuring it remains a living document, and also to disseminate those practical solutions. So we are therefore very pleased to be partnering with the International Finance Corporation to deliver this webinar series entitled New Deals, Funding Solution for the Future of Infrastructure. This session will showcase practical solutions and funding innovations used globally to fund sustainable and resilient infrastructure. So these sessions are meant to be very practical, based around real examples of transaction. They highlight on one end the transaction-specific characteristics that enable successful completion, but also the policy and regulatory factors that contributed to the success of the transaction or had to be overcome in the process. So this practical focus is also very aligned with the feedback we recently received from the GIHub Stakeholder Survey about the value of the GIHub practical resources. And here our objective with this series and partnership with the IFC is to create a forum where everyone involved in delivering infrastructure can share, discuss the approaches that are available or are potentially also being developed to be replicated across jurisdiction and sectors. So I would now like to introduce you to Morgan Landy, with whom I will be co-moderating today's session. Morgan is the Senior Director of Global Infrastructure and Natural Resources at the IFC. He will speak about IFC's work in this area and introduce us to the panelists and also the transaction that will be discussed today. So Morgan, the floor is yours.
Thanks, Marie. So nice to see you and nice to be here, and great to have so many people on from all over the world. So I'm waking up here in Washington with my morning coffee. I know Marie is closing down the evening. I don't know if she has a glass of wine with her or not, but anyway, tea, maybe tea. Great to see everybody, and IFC is really thrilled to be partnering with Global Infra Hub to bring this webinar series. And this is our first session of a series, as Marie mentioned. And really the objective from IFC side is to partner with Global Infra Hub to really tap into innovative ideas out there in the infrastructure world. What's happening in the emerging markets? How can IFC and Global Infra Hub really convene and play a role to share ideas and bring together participants to brainstorm and create opportunities for more? I mean, as we all know, again, first, my name is Morgan. I lead IFC's infrastructure practice. IFC is the private sector part of the World Bank Group, and our main focus is to promote private economic development in the emerging markets. So my focus is infra. And for those of us, and I think there are many of us on the webinar today who are infra people, I think the infrastructure market's really at an inflection point, especially in the developing world, where there's huge and growing demand, huge needs, and still challenges tapping into the capital markets. And how do we fund projects with donors, with institutional investors, with commercial banks, and how do we make that happen? So this is a key goal for both the GIH and IFC, and we're thrilled to really be convening this series of conversations. And really, it's not to hear from Marie or myself, but to hear from participants, to hear from you guys. So today's session is on capital markets. The series will have a series of different of themes. Today's kickoff session is on capital markets, which we see as really a super interesting area. And IFC has really, in the past 12 to 18 months, stepped up and seen huge opportunities and looking to see how we can support. As a DFI, as a development bank, how can we bring our capital, our expertise, our knowledge, and our clients into this space and play a valuable role to help move this forward. So with that, I'm really thrilled that we've pulled together a panel today with two premium clients from IFC. Liquid Intelligent Technologies, which is a major digital infrastructure player in Africa, and Continuum Green Energy, which is a renewable energy pioneer in India. And these two clients are longtime IFC clients who are we supported in the past 12 months or so to tap the capital markets. And it's not something IFC does on a routine basis, but something we're seeing as the COVID impact has hit, and the capital markets have become liquid in some areas. Some of our clients, such as these two pioneers, are really tapping the markets, and IFC is thrilled to help them do it. And in both cases, we acted as an anchor investor in their bond, which were both liquid, publicly issued bonds in the capital markets, one in Singapore, one in Ireland, to fund the growth and development of infrastructure players in emerging markets. So let me just introduce the panel, which again, I'm thrilled they've agreed to join us. So Kate Hennessy is the CFO of Liquid Intelligent Technologies. And Kate is going to speak to us about the perspective from the Africa digital world. Working with her was on the debt capital market side of JP Morgan was Jitendra Mistry, and Jitendra was a key partner of Liquid in their bond issue earlier this year. So Kate and Jitendra will talk about how the situation of capital markets looks from the Africa digital perspective. And then we'll shift to Arvind Bansal, who's the CEO and founder of Continuum Green Energy, a major renewable energy player in India, who tapped the capital markets this year in the Singapore markets. So Jitendra has agreed to talk about his perspective as a renewable energy player in India, tapping the capital markets. And we've also pulled in Sameer Gupta, who's the managing director from Deutsche Bank, who helped the Continuum to tap those markets and organize that bond issue. Again, IFC playing a role in both. And we're thrilled that all four of these colleagues have agreed to join us. So with that, maybe I can ask the colleagues to turn their phones on or their videos on. And I'm going to start with Kate. Kate, welcome. Good to see you there. So Kate's a longtime partner of IFC, and a lot's going on in the digital infrastructure space in Africa. Liquid's a major player with all kinds of operations across the continent. Maybe, Kate, I can ask you just to say a few words about Liquid to introduce the company to the audience, and then talk about the financing world you're seeing right now as a major digital player in Africa, and how you see the capital markets playing a role in this transaction that we worked on together last year. Kate, over to you.
Thank you, Morgan, and hello, everyone, and thank you for inviting me to this panel. Liquid Intelligent Technologies is the largest Pan-African fiber operator on the continent with over 100,000 kilometers of fiber. We also have data centers across the region, giving the chance for our customers across the globe really to have superior connectivity on the African continent, and our customers being the largest corporations, global corporations, right down to individuals on the ground with our fiber to the home product and our sort of LTE and other innovative products on the ground. So as you pointed out, Morgan, we first came to the bond markets in mid-2017 and successfully at that point arranged a 5-year $730 million US bond on the Irish Stock Exchange that had a coupon of 8.5%, which would have become due on the 13th of July 2022. This funding gave us a footing to be able to invest in expanding the infrastructure across the continent. Given the due date of July 22 and not wanting the debt to become current, we started working with our banking partners on a refinance in mid-2020 with the aim of having the refinance complete before the end of the year. We specifically looked to DFI involvement to anchor the bond, and IFC's involvement in that was very key given the strong development focus of Liquid, and with macroeconomic market instability, a desire to demonstrate to private investors that DFIs had confidence in our plans. As ever, market volatility has a big part to play in the timing of transactions. And to exacerbate this, we of course had the ongoing impact of COVID-19, as well as the instability due to the US presidential election. This meant a viable market window didn't appear till February 21. We also needed to put in place a RAND term loan to mitigate our exposure to ZAR, which brought with it additional regulatory hurdles and a need to align to the bond process. As a result of all of that, on Monday, the 22nd of February in 2021, we saw an opportunity and moved decisively and announced the mandate for a concurrent 5-day any and all cash tender offer for our previous bond. Over the next 2 days, we hosted 13 investor calls, which were attended by about 80 different investors, as well as a big global investor call with 58 attendees from 55 different institutions. And after the 2 days of marketing, the new issue had received over $1 billion of indications of interest from investors. So this gave us the confidence to launch the book build and the pricing on the 24th of February. The tender offer expired on the 26th with a very high participation rate of 76.55%, which helped to minimize the cost of carry on the remaining notes. So the outcome was a hugely successful refinance, a landmark deal for both liquid and Africa issuers, the first ever 5-handle coupon achieved by a single B African corporate issuer. 5.5% coupon was 300 bips tighter than our debut bond, which was a huge cash saving for us. And the final book of $3.2 billion was 5.2 times oversubscribed, which also enabled us to upsize the transaction from 600 million to 620. And we were certainly helped by having key DFI anchors, of which the IC was the largest. Having secured this financing, we can continue our ongoing investment plans, which will assist in addressing the key development gaps in telecommunications sector across the sub-Saharan African countries in which we operate, as well as to accelerate the adoption of digital and cloud-based services. These are countries that face significant development gaps in telecom and internet access, and these challenges particularly affect low income and rural residents. To use a pertinent stat, of the 513 million people in these countries, only 23 million are mobile broadband users and 3 million use fixed broadband. So this financing really is going to make a big difference to these communities.
Okay, thanks so much for that. And as you speak, I'm having flashbacks to our negotiations and conversations in the moment of how to do this and when the timing was right. And from IFC side, we're thrilled that the transaction took place and was so successful and really helped you, as you said, tighten your spread on your borrowings significantly at a kind of volatile time in the markets. Let's turn maybe to Jitendra. Jitendra, from the book runner side, working with Kate and team on this transaction, how does it look from where you sit, and what were some of the key features that maybe our audience could be interested in?
Yeah, thank you, Morgan. And thank you once again for everyone for being invited on to this webinar. I think from a structuring perspective, one thing to note, when we talk about infrastructure and the bond market specifically, it's important to make a clarification here. Now, typically, infrastructure has been funded through project financing, either loans or bonds, which are slightly more structured instruments and becoming more and more common in emerging markets. However, that wasn't the structure which was used for liquid telecom. Liquid telecom is a separate case from that, where we were effectively issuing a bond at the corporate level, given Liquid is a technology company with significant infrastructure assets. And so it wasn't tied to any specific project, but it was more corporate level funding. So I think that's probably an important clarification to make when we talk about the transaction. Now, when it comes to the structure, there's a few factors which I think are probably quite interesting. I'll just touch upon the ones which I think are most key. The first being that the issuance, as I alluded to earlier, was done at the holdco level. And just from a structuring perspective, in terms of what investors look for, it's important that the credit group and the guarantor structure reflects the risk appropriately. And so what that ultimately means that we try and capture the material part of the credit group with upstream guarantees from the subsidiaries. Now, that can be quite a complicated structuring element because depending on the geographies in which you operate, there can be regulatory hurdles with granting upstream guarantees to a holdco, as well as sort of exchange controls, etc. So that part of the structuring piece does require a fair amount of thought, and luckily we had a good base to work off because Liquid Telecom had their original bond outstanding, so we ultimately replicated that structure. The other thing which I think was quite interesting here is, again, I'll talk more generally about emerging markets, but more, and then also specifically about liquid telecom, is that this issuance was done on a secured basis. So it was a senior secured bond. Now, not all, to access the market, both unsecured and secured options are available. And it ultimately comes down to a bit of a corporate financing decision for the company. When a corporate is effectively using a bond as a majority of its capital structure, it often goes and moves down the route of unsecured, because the capacity to raise future secured debt is not needed, and so raising this unsecured bond is generally the course of action. But Liquid Telecom, as Kate mentioned earlier, also put in place a term loan alongside the bond. And so secured funding, I think, is an important part, in ensuring that the company has diversification between loans and bonds was an important consideration here. And so ultimately went with a secured issuance. Now, in emerging markets versus developed markets, the pricing benefit for security is probably not as dramatic. And that's largely because investors sometimes question the enforceability and the value of the security versus they would in more tested geographies. Now, I think in the case here, what I mentioned before around this becoming more of a corporate financing decision was probably the more relevant piece for Liquid Telecom. And then finally, the structure was done with a typical set of high yield covenants. I think that's become quite well established, especially in the African corporate space. So there wasn't anything too surprising there. And then, as you mentioned earlier, Morgan, the bonds were listed in Ireland. Now, what I would say about listing location is that most investors are agnostic as to where the bonds are listed. It's just a question of a bit of a tick box exercise. So traditionally, you see high yield corporates or sub-investment grade corporate issuers listing either in Ireland or Luxembourg, but increasingly issuers are now listing on the Channel Islands because it has more lenient reporting requirements, and from a regulatory point of view, it falls out of scope of the market abuse regulation. So it provides the issuer a bit more flexibility.
Fantastic, Jenna. Thanks so much. Maybe I'll hand over to Marie. Marie, I think you had some questions.
Yeah, and let me start with you, Kate. Because today we've got a lot of policymakers in the room. I think that's also the idea of having this joint session with the IC and us there already working with the G20. So I would be interested to know, how did the policy environment in South Africa, but also Ireland, help facilitate this deal reaching financial close? And what would you like to see in other jurisdictions? Because I think in your story here, there is a lot to learn, trying to see how this could be replicated.
Yeah, thank you for that, Marie. I think, Jitu highlighted there that the financing came in two parts, as you rightly pointed out, the bond on the Irish Stock Exchange and then the South African Rand term loan. In particular, in South Africa, you have to factor in the requirements and scheduling for the South African Reserve Bank approval, as South Africa's got exchange control rules. So while we were familiar with the need to obtain those approvals, you need certainty of your deal structure before you can actually go and apply for that approval. And we knew from past experience that this approval process needed to be managed as part of the overall process, but with COVID happening at the same time, we were concerned that that review process may have taken longer than the stated weeks that it normally does. For the bond, which is listed on Euronext Dublin, formerly the Irish Stock Exchange, as Jitu pointed out, the regulatory and policy environment is very well developed, with a strong business framework which has been attractive for large businesses and foreign direct investment, a good track record of capital raising, and the benefits of being both English speaking and part of the Eurozone. So really, historically, that's been quite a good go-to market for high yield bond issuers. That being said, as Jitu pointed out, Ireland, because Ireland is part of the EU, the bond falls within the mandate of the EU's market abuse regulations, otherwise known as MAR. And, although that was introduced to reduce regulatory complexity and compliance costs for firms, especially for those operating on a cross-border basis. Certain requirements can be burdensome and costly, and there are quite a lot of reporting requirements. As a result, quite a lot of issuers are now looking for alternatives outside of the EU. The International Stock Exchange in the Channel Islands has been set up, and even though they still maintain robust market abuse roles, people are starting to see them as a viable exchange because they have lesser reporting requirements, as Jitu pointed out. From our perspective, and this goes for the bond and the term loan, clearly a strong framework is hugely important. There must be robust regulations that meet investor expectations. I think that's very key for us, because obviously if the investors don't want to come to an exchange, then there's no point in looking at it. But also a framework that strikes the right balance between the regulations and a pragmatic approach to disclosure requirements. Another advantage for us is an exchange that sits in a comparable time zone. With regard to the RAND term loan, the decision here was driven really not by the regulatory and policy environment in South Africa, but a desire to reduce our currency exposure. So it's not best practice to have all our debt in US dollars when our largest trading currency, which accounts for about 40% of our sales, is the South African rand. Ideally, actually, we would have looked at a South African bond as well, because the rates do tend to be lower than term loans. But in South Africa, there's not as developed a market for corporate bonds as there is in Europe. So look, that being said, we're happy with the two elements and how they've played out. I think in general, jurisdictions do need to look at other factors here. There's also a growing rollout of taxes on the African continent, such as digital taxes, excise duty on broadband, in addition to VAT, corporation tax, and withholding tax on interest. And I think the growing combination of those altogether will also influence future investment decisions.
Thank you very much, Kate. I mean, a lot of insights in there. I think also in terms of balanced regulation, disclosure, and the fact that indeed, ideally, you would have liked to source a bond in South Africa, and how this could be enhanced moving forward, given, of course, corporate bond in South Africa, but in many other places in Africa, still fairly limited at this stage. So lots of good insight. Another question then would be, how have the lessons learned from this transaction helped shape your approach to future transaction, or help shape a new strategy? And I'm particularly also interested in your views on how the role of IFC in helping with investors' confidence and also Moody's perception of the deal that evolved quite a lot. How was this instrumental?
Well, just on the sort of overall transaction itself, and I won't presume to be an expert here in terms of all things related to debt issuance, because it's only our third time that we've come to the market. But I think certainly, you know, if I was giving advice to other people, particularly being African issuers, I think you have to make a big conscious effort to be accessible to investors, conferences, roadshows, results presentations, incoming requests. I think that's been hugely beneficial. You know, our business isn't always straightforward. It's got nuances. We're operating in challenging markets, you know, some markets that people really are not, have any information on whatsoever. So I think having a good core of investors that we've interacted with regularly, to whom we provided background on all these nuances, I think does ensure that there's a number of well-informed investors out there who know us well. I think it also helps to deliver. So we came to the market initially in 2017 with certain objectives, and many investors from our first bond re-entered the next time round, and hopefully recognize that growing track record of delivery. The other thing I would stress is to be very flexible to respond to markets. As Morgan quite rightly remembers, we had to be able to move very quickly, and we had a number of interested parties in the timing of the bond, but we had to make sure that everybody was on side with what the plan was, so that when the Treasury rates were where we needed them to be, we could launch the bond very quickly. I think, you know, touching on the IFC's involvement, I think something that's very key is that Liquid has always had very strong developmental aims, you know, even really before ESG became a focus topic. And now private capital is also paying a lot of interest in infrastructure, as Morgan highlighted at the beginning. You know, we're in the middle of a major program to connect more schools in Africa. We're continuing a big push in higher education. 95% of the universities in Zimbabwe are now using our connectivity. We're working with UNICEF to map and connect schools. So wherever we pass by schools with our infrastructure, we can connect them up. And we also support startup businesses with our innovation partnership program. This lets us provide these hubs for free with subsidized internet. And we've partnered with an agency to give us data on what this means for small businesses. And so far, 1,700 of them have raised capital on the back of having access to this infrastructure. And specifically with this transaction, we're doing a lot of work in the DRC. So we're going to roll out with the extra money we raised on the bond. We're moving our fiber to the home from 6,000 homes to over 70,000, doubling the size of the network and reaching 75% of the population in the DRC. So, that we know that contributes to an overall growth in GDP when you invest in communications infrastructure. So I think overall, because Liquid has always had these aims, we were a perfect partner for IFC in many ways, because although we are a private company, we really have a strong developmental focus on everything that we do. And I think being able to partner with them was a perfect opportunity for both of us to be able to expand our horizon and roll out more infrastructure across the continent with IFC support. On the Moody's side, something about debt capital markets that's also very key to remember, particularly if you're not a listed entity, which we aren't, is that having a listed bond means you get the chance to get Moody's or credit agencies on board with a rating for you, and that rating is very valuable in the market. It's a very useful currency to have, to be able to state that you're rated by people like Moody's and the other ratings agencies, and that also took an awful lot of work. I mean, if you are someone who operates across the continent, there's a lot of higher risk attached to the business that you're doing, particularly with cash flows and moving cash in and out of countries. So you have to put a lot of work in and a lot of detailed analysis for the ratings agencies to be able for them to come up with analysis on you that enables them to give you a rating. And that rating is very key for the bond because it gives confidence to the investors. So I think, all in all, the development aims really came out with this bond. And, as we roll out the network across the DRC, I think we're going to make a big difference to a lot of communities on the ground.
Yeah, thank you very much, Kate, for all of those insights and lessons learned and all of those different front and really impressive continuous development. So that's great to hear. I will hand over to Morgan that has a question for Jitendra.
Great. Thanks, Kate, for that. And great to hear your perspective. And actually, just looking at the time, Marie, maybe I suggest we shift the focus now to India and ask Arvind and Sameer to turn their cameras on. I think Kate and Jitendra have really helped us to see how these capital market transactions look from the perspective of digital infrastructure in Africa. Now shifting to another part of the world, Arvind, from the India perspective, maybe just you can give the audience 30 seconds or so background on the company, what you do, and then think about why did you choose capital markets? Why do they make sense for Continuum to tap the markets, and how do they look from the company's perspective in India?
Thank you, Morgan, and thank you for inviting us to this panel, and thank you for all the people who attended it. Continuum Green Energy started its business in 2009, and the Indian renewable market is a fast-growing large market today. Continuum has about 820 megawatts of operating capacity and another 500 megawatts of capacity under construction, with another 2 gigawatts to go under construction in the next 2 or 3 years. We've been supported by Morgan Stanley Infrastructure Fund since 2012, when they made a commitment to invest $200 million of equity in our business. And soon after that, in 2014, we received support from IFC for our 170 megawatt wind farm project in the state of MP. So at Continuum, one of the differentiated strategies we focused on is to address the corporate PPA market. So we are the largest sellers of renewable energy to the corporate sector directly, bypassing the grid. And that involved a different set of challenges for financing, although it is a more profitable segment, but it was not the main discourse in the Indian markets, where the primary focus was on long-term utility PPAs at fixed tariffs, which were being awarded through competitive auctions. And these auctions were leading to significantly lower returns in the projects. And we were comfortable doing this corporate PPA market, but had to solve the dilemma of getting long-term financing from a number of wide range of banks. While we were able to finance these projects in India from the domestic sector, but there were very few banks or lenders who were comfortable doing this. So when we launched this exercise in 2020, we chose and set 3 objectives for us. One was, of course, to get a reduction in our cost of debt, because all of our assets were financed on a standalone SPV basis in a typical project financing structure, and that brings its own costs. Secondly, we wanted to deepen the access to debt markets for our corporate PPA business. And that would mean that if we are able to finance it through the bond market, then we provide higher level of comfort to domestic lenders that they would be able to recycle their position in the debt, and we would hopefully attract more and more debt providers to our business. And third objective was to get a public profile for the company. We were, although institutional owned, but we were a private entity, and in the run-up to a potential equity listing, we wanted to practice and gain experience of handling corporate reporting on a quarterly basis, handling investor queries, and being able to market a story to a large number of investors. So with these 3 approaches, we started the exercise, and we initially started in the domestic market. We wanted the credit rating agencies to first evaluate how would this debt package look like. So we worked with the domestic rating agencies, and in parallel with Sameer's help from Deutsche Bank, we decided to engage with Fitch and Moody's to engage into a rating exercise on an advisory basis, because this was the first offering from India which would be comprising of a large section of corporate PPA renewable projects. Until then, all the bond offerings from the renewable industry were with projects packaged with the utility PPAs on fixed tariffs for long term. Since we were attempting something new, that would mean that we had to spend a lot of time in distilling our story in a manner that investors can evaluate transparently, evaluate objectively. And that needed some effort. So we worked with these rating agencies. When we were comfortable that we would be able to achieve a good rating, which would result in a reduction in cost of our debt, we then embarked on, I think the other very positive and strong advice we received from Deutsche Bank was to engage in a non-deal roadshow. So we engaged with a few select investors, a dozen of them in November, after we had completed the rating advisory business. And we received some very important feedback from investors to what they like, what would be the questions that we'll have to address during a bond exercise, and what will be our reporting requirements, what are the expectations of the investors. And we launched that. So that gave us very good feedback. But at the same time, we were heading into the year end, and therefore we had to wait for the offering until the new year. But it gave us good time to prepare for our offering. We engaged. One of the other thing we realized from the non-deal roadshow is that getting an anchor support for the bond is very, very critical. And one of the goals we set for the management team is to have at least 1/3 of the bond covered before we launch the roadshow, so that we have a high probability of success. And in that process, our relationship with IFC came very handy. We made an approach to IFC in late November. We had a presentation on the concept, and IFC had known us and had been our lender since 2014. So it was great to have the support. And IFC eventually became an anchor investor in our bond. And for an investor of a quality of IFC to be an anchor investor means a lot to the success of a transaction. So we worked with them, and when IFC received its internal approvals to be an anchor investor in late January, we launched the roadshow, and we announced a roadshow on that day. By that time, along with IFC and other anchor investors, we had about 40% of the book covered. So that gave us tremendous confidence to launch the offering. And on 2nd of February, we then launched a roadshow, and had a fantastic outcome with 6.5 times oversubscription to our $560 million bond issue. The few things that the other very valuable outcome of this is that it was able to provide us a public profile to be able to market more successfully to future corporate customers. Corporate customers, therefore, had a public document to diligence on us before becoming a long-term customer. And that has been a very strong benefit of the offer. We've been able to successfully change the discourse in the Indian market from utility PPAs to corporate customers, to the extent that we believe it is now a buzzword. And very recently, Government of India came with a very important set of rules to make open access sales to corporate PPAs much easier and more attractive than before.
Arvind, thanks very much. I'm sure you could go on for forever giving the story, because it's really an interesting one and very innovative. And again, IFC, we're super happy to be supporting you in the effort. Maybe Sameer, I can ask a question to you from the book runner side of the Continuum transaction. How does it look from your perspective? How did you kind of help advise Arvind and company? And what are some of the interesting aspects that our audience may be interested in about how does this compare, for example, to the Liquid Telecom transaction we heard about earlier in the webinar?
Sure. So thanks, Morgan. Thanks for having me on this panel. So look, where the transaction structuring is concerned, I think there are two aspects to this transaction structure. First of all, within the Indian regulatory framework, how do you give investors a direct access to securities and cash flows of these assets which we've presented to the bond market? So in order to do that, the transaction was structured by raising a dollar borrowing in the international markets to a Singapore entity, and using those funds to subscribe to a rupee instrument of basically a restricted group of projects in India. Now, this ensures two things. One, from an Indian regulatory perspective, this is a rupee liability on the Indian assets, and from an international investor community perspective, they get access to basically invest in these assets in a dollar format. So Singapore entity is effectively acting in a way as a repackaging entity, where they're repackaging this rupee liability into dollars and then selling it to dollar investors. So that's, I think, the first aspect of the structure. I think the second aspect of the structure is overall how the transaction is being packaged in terms of the covenants. And I think how it was slightly different from what we heard in the earlier transaction is that this is a typical project financing structure. So this was not done as a corporate bond structure. This was done as basically a project financing structure where we have a set group of assets. And based on the cash flow profile of the assets, we've come up with the transaction structure, which ensures that the bondholders and the sponsor interests are aligned. So based on a stressed scenario of cash flows, we have ensured that the bond has an amort profile, by way of which 50% of the bond sort of gets paid down during the life of the bond. And when I say that the sponsor and the debt investors' interests are aligned here, the sponsor is incentivized to do better than the stressed scenario of the cash flow. So that, because when he does that, it is only then that he will be able to take out dividends from these assets. So those, I think, would be the two key aspects of the transaction structuring. One, how to give investors a direct access and at the same time comply with Indian regulation, and the second being the entire project financing structure where the interests are aligned.
Great, thanks, Sameer. Murray?
Yeah, so Arvind, I would like to ask you basically the following question. Would you say that does accessing bond markets by company mean limiting the role for long-term projects financing? And also, what would you like to see in our jurisdiction?
Thank you, Murray. That's an interesting question. In emerging markets, the context of project financing is quite different compared to developed markets. In emerging markets, the person behind the project is as important as the project itself. And therefore, even if you structure, different debt packages and different SPVs, default in a particular SPV is a non-option. So even though you are looking at project financing at SPV levels, it effectively means you need to make sure that there is no default at any of the assets. And in practice, it's balance sheet financing. So therefore, if I have a lot of equity support, I would personally only follow balance sheet financing and not project financing, and pay for the additional cost of project financing while not benefiting from the covenant package there. Having said that, as Sameer mentioned, in our case, it was a project financing bond. So the bond is not being corporate guaranteed. It is the bondholders have access to cash flows of a defined set of projects. But we realized that from the interaction with the investors that international investors are either unable to or unwilling to price construction risk, which is essentially a bunch of local market factors. So project financing during construction phase is very, very important and has an important role to play. And if you are able to recycle that capital from the bond markets, that actually meets the objectives of both the project finance lenders and the corporates, because project finance lenders typically don't have asset liability matches for long tenor project finance debt. So if you access the project finance market domestically with construction debt, and then soon after construction or some period of demonstrated successful operations, you replace it with the bond markets, it makes everyone happy.
Yeah, thank
Having
you
said
very much.
that,
I'm sorry.
Sure, please go ahead. Your other question was what would we like to see and what are the enabling factors from a policy perspective? I think one of the key things that helps for Indian renewable sector to be able to sell itself is the commitment of the government. It's an irrevocable commitment to renewable energy sector, and there is a high level of confidence on the trajectory for renewable market growth. The second factor is, government has been doing progressively taking steps to simplify the investment in both equity and debt markets from international investors. Having said that, there are a few kinks. For instance, there is an issue of withholding tax, where the government extends the withholding tax regulation on a year-by-year basis. It would mean a lot more to the bond markets if the withholding tax regulation is defined for a longer period of time rather than taking a risk on an annual basis.
Thank you very much, Arvind, for those insights. I think it's particularly insightful in the context that you described. So I'm also conscious of time. So I think if we want to have enough time to hear from the audience, because I know many of you have been using the Slido app that allows to really ask questions and vote for your preferred question to allow that at least we are asking the question you're interested in to the panelists. I think we should probably get into that Q&A session now. So maybe if we could get all of the other panelists on screen with us, and then we could start.
Great. Thanks, Marie. Welcome back, everybody. Welcome back, Kate. Welcome back, Jitendra. So super interesting to kind of compare and contrast the two different experiences, and many similarities, but many differences, and great to have your insights. So I have one question for Sameer and Jitendra, really from the book running side, from the market side. First, maybe Sameer, can you talk about the bond market investors in Asia? And what you're seeing in the market, what's the appetite? Are things changing in that market? And then Jitendra, maybe how do you feel about, we talked about corporate finance versus project finance and refinancing versus greenfield. Maybe Jitendra, how do you think about that? Are the capital markets ready for project finance? Are the investors willing to step into that greenfield market of greenfield project risk, or really it's not appropriate, and the risk reward really isn't there for the investors? Maybe first Sameer and then Jitendra, please.
Sure, Morgan. So I think, look, from an investor-based perspective, I think where demand from investors for Asia or EM in general is concerned, I think what we've seen is that now we've got all classes of investors who are interested in taking credit exposure here. So we've got all classes from long-term real money funds to hedge funds to banks to pension funds. All sorts of investor classes are present now who want to basically take on EM exposure. I think emerging markets has become a significant sizable allocation within the fund. So it is a sizable strategy which a lot of funds have, and they have basically separate allocations. I think one growing trend which we are seeing is the growing focus on ESG. I mean, just to give you a sense, last year out of India, we had about $1 billion of ESG issuances. This year till date, we have already had ESG focused issuances in excess of $7 billion. Similarly, if you look at the case of Asia, to start off with, last year we had something like 16 billion, and this year to date, we've probably been in excess of $40 billion. So what we're seeing is a rise, is a very growing trend of ESG focused investors, and a pretty tangible benefit to issuers who are ESG focused and who are doing paper which complies with ESG norms. And we do believe that this is going to continue to grow. I think ESG is not going to be a hygiene factor anymore, but it will become it'll just become of great importance in terms of achieving your objectives as a borrower, because the demand from ESG focused investors is going to continue to grow.
Thanks, Sameer. Jitendra, how does it look from where you sit? And this question also about greenfield versus existing assets.
Yeah, firstly, just sort of covering overall risk appetite. And what I'd say is what we've seen both with the liquid telecom transaction as well as a whole host of other transactions which have come in debut format is that, overall risk appetite is definitely there in the market, especially for countries which may seem a little bit hairy or frontier, on first glance. I mean, liquid telecom has operations in Zimbabwe, DRC, etc. So, the fact that projects or companies are based in some new geographies isn't something that sort of locks you out from the market. I think the overall investor space is quite open to looking at new geographies. I think the question of project bond versus corporate bond is an interesting one. The project bond asset class is one which is established in emerging markets. There are a number of issuers who have issued project bonds. I think naturally a project bond is going to have a much more structured covenant package as well as overall deal structure to address all the risks that come along with a single standalone project. Now, it's not as common as the overall corporate bond market that you see in EM. And it's a lot more selective about where you see, the right scale of project and the right profile of project coming to market. But it is definite that there is definitely an investor base, and it is a growing asset class. I mean, every situation is unique, and considering whether it's a project, a project bond structure versus a corporate bond structure, just requires analysis of the situation.
Great, Jitendra. Maybe Maria, I know you've got a series of questions coming in from the audience. One thing that came up earlier, I saw a question on the chat about ESG, and Sameer also mentioned it. Maybe I could say a few things and ask Kate to kind of chime in. It does seem that ESG is really moving to the front of the market mentality in terms of what investors are expecting from investees. Of course, at IFC, it's always been a part of what we do. And actually, before this current role, which I've been in about 3 years, my last job was head of our ESG team at IFC for 4 years. So, and what we saw there and what we see now is that there's a huge move in expectations. The market expects companies to be ESG compliant. They expect companies to be ESG leaders. And it's no longer, from what we're seeing, and I'd love to hear, Kate or Arvind, how you see it, it's no longer that it's just risk management. It's really people want to be doing good. They want their money to be impacting positively the world. I'd love to see, first of all, we need to make sure, and IFC of course does, when we invest in a capital markets transaction like these two, or in any of our work, we're always screening against our environment social performance standards, which we use across all of our business to make sure that our clients understand what our expectations are in terms of risk management and communities and labor issues, etc. But I think it's the market's kind of moving even faster. How does it look, Kate, from your side, or Arvind? What are you hearing in your markets, and how does ESG play into your funding concepts?
Yeah, thank you, Morgan. I think it is moving very quickly, and I think what we're seeing from investors in particular is they don't want to just hear the story, they want to see the facts. So, whereas before you could tell them what you were doing and, people would listen and think it was very good, but actually they now want to know the statistics behind what you're saying. And, it's not good enough to be able just to tell the story. You have to be able to produce the facts and demonstrate them on a quarterly basis, which chimes in with our reporting. So a lot of our bond investors this time round, we specifically got involved with their ESG teams. It was a really big focus. And, as you point out, the performance standards, the IFC's performance standards, they want to know that we can meet those standards, that we can report against those standards, and that they don't expect you to necessarily be at the stage where you can meet them all, but they certainly expect you to have a roadmap as to when you will be compliant with all of them. And I think that particularly in emerging markets, they do accept that, there may be greater challenges in the markets that we deal in, but that we need a map to get to the point where we can comply.
Great, Kate. Arvind, how does it look from where you sit?
Yeah, I think I echo fully what Kate said, that ESG market is moving very rapidly, and it's more of a parameterized approach to ESG compliance. And investors need to see your commitment and your roadmap and actual actions that you've taken on ground to deliver on ESG matrices. And in our case, we had an added feature to our offering from an ESG investor perspective, that we enable approximately 100 plus corporates to meet their sustainability objectives by purchasing renewable energy from us. And therefore, that provides an added impetus to the ESG movement, which was hitherto dependent only on the distribution utilities. But we are able to get our corporate customers to participate in that phenomenon. So it's been a learning of how investors have viewed ESG. And as Kate mentioned, a number of investors who participated in a bond had 90% focus on ESG issues and 10% focus on numbers. And we continuously receive a number of ESG related queries from our investors, whether it is on our sourcing strategy, whether it is on our governance matrices, or on our corporate social responsibility deliveries from our project sites. So it is a movement, and I think borrowers would do well to not only comply but stay ahead of the curve.
And maybe, I don't know, Jitendra or Sameer, anything to add from your side as you talk to investors and you're in the markets? Is ESG kind of a fad, or do you think it's here to stay?
Maybe I'll go first here, and Sameer, I'll hand it over to you. I think from an ESG perspective, it's definitely here to stay. It's become a very meaningful asset class. Investors now have dedicated ESG portfolios which they can allocate bonds to, and typically we do see a much more sort of incremental demand coming for ESG related issuances, because I'm not sure the supply of labeled ESG bonds naturally meets the level of demand that's out there for them. One thing I would say is, the ESG label to either issue in green format or sustainable format can, as a use of proceeds bond, can be quite a rigid process, in that there are very defined uses of proceeds which qualify for an ESG label. So in instances where a corporate is doing a lot of development impact good, but perhaps doesn't tick the boxes to generate an ESG label, you can find that investors are very keen to hear about the ESG story, but the issuer isn't able to issue in that sort of defined green or sustainable bond format. And interestingly, at the JP Morgan side, what we've done internally is set up a development finance institution within JP Morgan that is able to qualify transactions and really enhance the story around the development impact of that corporate and that transaction. It's something that we actually utilized for the Liquid Telecom transaction, where we beefed up some of the disclosure and marketing materials to really drive home the fact that there is a much greater development impact story associated with the name that shouldn't be lost just because of the fact that it wasn't issued in a green or sustainable format with that label.
I would echo what Jitendra said, and look, I would just add that what we have seen is that now ESG labeled issuances show tangible benefit over non-ESG labeled issuances, and these can be in terms of higher size order books, these can be in terms of lower pricing, this can be in terms of access for more aggressive structures. So we believe this is here to stay, and issuers will do well, as Arvind said, to not just comply but be ahead of the curve where ESG is concerned.
Great, thanks, Jitendra and Sameer. So Marie, just looking at the clock and mindful of time, and also I know it's late in some parts of the world, and we promise to finish promptly. Maybe I'll say a few observations and then hand to you for the closing words. So, I mean, if I think about this conversation and the work we've been doing with all of you, and also what we see happening elsewhere, it seems to me that the market is in fact moving. And for companies like Liquid, companies like Continuum, the capital markets are a real viable option to finance infrastructure, which of course there are different regions with different opportunities and different investor appetite. I think this whole question of project finance and greenfield risk versus corporate finance is an important one, and I guess it's really case by case basis. What we're hearing from our capital markets experts is that there's not one size fits all. It really depends on what's the risk appetite of the market and how does the company present itself, and what's the kind of expectation of how do you tap into the markets. And of course, there's different terms available for different kinds of issuances. But it seems like to me, and what we're seeing at IFC is the capital markets do present an interesting opportunity for borrowers to tap into the markets to complement term loans. As Kate was saying, in Liquid case, it wasn't just the capital markets issue, it was capital markets and then a term loan. So what we're seeing probably is a combination of different tools, but there is a huge amount of capital out there looking for good opportunities. And as we see in the emerging markets, opportunities in the emerging markets are sometimes complicated to reach for investors sitting in the developed parts of the world where they're looking across the whole globe. So I think from IFC side, this is a huge opportunity to step in and be creative, to try to work with our clients and with investment banks and market participants to see where we can bring things together. And from a development perspective, tapping into capital markets, helping link the flow of money into productive infrastructure assets, whether it's digital telecom assets, whether it's renewable energy, or water, urban, municipal, transport. All of this is super important. And from IFC's perspective, we're thrilled to be working with the Continuum, with Liquid. And I want to thank all of our participants for joining, for giving us their time and sharing their perspectives and being real partners of IFC. We look forward to doing much more together. And maybe with that, I'll hand it back to Marie for the final words.
Yeah, thank you very much, Morgan. And indeed, I cannot echo more. And thanks to the panelists. Also, you, Morgan, and the IFC for your collaboration and partnership on this series. And to all of you who have joined today, I really hope that you found the discussion practical, solution focused. And this is actually what we have planned for the series. And yeah, I hope you really find it useful. We had also some very interesting discussion, I note, on the ESG in the end, which is really some of the topics that we're discussing at the G20 this year. Actually, in the upcoming month, we'll have a presentation that we'll provide to the group, because it's also important to provide that market perspective to policymakers to understand the urgency of putting the right regulations supporting that change into the market environment. So please take a moment to give us your feedback on the survey that will be popping up. I think Jordana put it into the chat. And I think this is important because this is a new format and we have other sessions planned in this series, so we can take your feedback into account to further shape the future session. I also encourage you to keep the conversation going. This is all about that, right? The right people at the right time discussing the right projects. So let's keep this going. And the Tiara and the IFC will both be sharing links to some follow-up content on this session, which includes the case study for both of the transactions presented today, as well as additional commentary from the panelists, from Morgan and also myself, about the issues that we discussed today. You can find this on the website and social media channel. And last but not least, if you haven't already, please register and join us for session 2. That will take place on October 6th. And until then, take care and thank you again.
Thanks, everybody. Great to see you. Have a good week.